Hello everyone. Welcome to this training program on the finance for non-finance professionals. Till now we have looked at the various areas relating to financial accounting as well as management accounting. Now let's move on to understand the third major aspect as a part of our curriculum, which is capital budgeting or financial management. So within this financial management, I would be covering three major areas which are required to be understood by almost everyone. The first of these being capital budgeting. Then we will also spend some time in terms of understanding the various sources of financing and also aspect relating to the working capital management. So to start with, when we look at capital budgeting, one of the prime roles in any company of the finance department is to evaluate various projects that come in their way from the financial feasibility standpoint and typically provide decisions whether to accept that particular project or reject a particular project, and how much budget need to be allocated for that project, or how much is it worth to invest in that particular project. This is one of the key roles of any finance department or a finance manager in a company. So, evaluate the various project proposals that are coming to the company, look at their financial feasibility, and provide an accept or a reject decision. This world of evaluating projects and assigning budgets to them is what is the world of capital budgeting. Then what is the meaning of this word capital here? Typically any project or any assignment for which I'm expecting that the benefit, right, any investment that a company is doing, if it expects that the benefit out of that investment lasts for more than 1 year or beyond the current financial year, we are calling those kind of projects as capital projects. Let's say I purchase a machine. That machine is expected to give me a benefit of more than 1 year. Probably for the next 5 years, that machine is going to benefit my organization. In that case, the decision which I am taking to invest in the machine, whether is it profitable to invest in the machine or not, and how much is worth to be invested in that particular machine, all these decisions fall under the capital budgeting decisions of the company. And one important thing in this context is the capital budgeting decisions are very important decisions as far as the companies are concerned. They are probably the heart of the company's functioning. The reason being, every capital investment, capital budgeting decision, whether it is in terms of geographic expansion, because once I move to a particular geography, the benefits may not come immediately. It is a very strategic move. But I'm putting a big investment today when I'm choosing on one single geography. If things don't work out, it's going to have a very heavy impact on the financial viability of the company. So it could be a geographic expansion, it could be a product line expansion, right? Any expansion products, or probably any replacements, a new machine. I'm trying to purchase a new machine, either by replacing the existing machine or probably buying a new equipment for cost effectiveness, whatever. When I am looking at all these kind of aspects, it is very clearly coming out that all these decisions, they involve a huge amount of money, and two, they do not give me the benefit immediately. They give benefits over pretty long period of time. So once you have taken a decision of investing in these particular projects, it's very difficult to get out of that. So that is the reason, as a decision maker, you need to be very much prudent in terms of exercising your decision on what kind of capital projects need to be undertaken. From that standpoint, there are a few mechanisms. Once you have identified a list of capital projects for your company, there are a couple of mechanisms in which you can evaluate the capital budgeting projects, and based on that, take your decision on whether a particular project needs to be accepted or rejected. So we'll look at some of them. The prime tools which I would be covering, one being the accounting rate of return. I would come up with the payback period. Then we would also discuss the concepts of net present value NPV and internal rate of return IRR. Four solid tools to evaluate the worthiness of a project. They look at different dimensions from the profitability and the cash flows perspective to provide an accept or reject decision about the viability of a particular project. Let's look at one by one. Accounting rate of return. This is one simple tool that provides us a decision to evaluate the capital projects based on the profitability of the company, not the cash flows. This is the only tool out of the four which we are going to discuss. The remaining three tools are based on the cash flows of the company, whereas this is the only tool, accounting rate of return, is the only tool that focuses on the profitability of the company, which means without computing the cash flows, I can talk about the profit after tax of the company, right? So if I'm talking about a 5-year project, every year I look at some profit that is expected. So today I'm investing in the project. For the next 5 years, I project, let's say, a 15% profit in the next year and a 20% profit in the next year, 25 the next, and probably 20 the next, and 15 the next. So if I'm expecting that the next 5 years my profits are going to be something like this, all we are talking of is find out that particular annual profit as a proportion of annual investment. So let's assume that the investment is the same over all the period. Let's say my revenues are also the same 100 in each of the periods. So what it is telling me, my profit each year is going to be like 15, 20, 25, 20, and then 15. So which means overall my profit is going to be 100 for a 5-year period. So I can take that 20 is the average annual profit. So I'll take average annual profit divided by the average investment. So here the profit which is being computed is from the P&L statements of each and every year. As I said, this is the only which uses the profitability of a company for evaluating the decisions rather than the cash flows. So, as this is clearly pointing out here, I will take the average annual profit of the company or of the project and divide it by the average investment, which will give me the ARR. And a simple rule for me, the higher the ARR, the higher is the chance to accept the project. Even if I have 10 different projects in my mind or in my available with the company to take up, and I'm using ARR as a mechanism to evaluate the worthiness of the project, then a simple thumb rule for me is the project with the highest ARR of the various that are available would be chosen. Or probably if I can choose 2 or 3 projects depending on the total budget I have allocated for my projects, I can choose the top 2 or top 3 which are having the highest ARR values compared to the rest. So the decision rule is quite simple, and there is no complex calculation that is involved with it, for the simple reason, for every company, for every project, there is a projected P&L statement that is prepared, and you know how much is already invested in that particular project. So all you may have to do is find out the projected profit for each of the years and estimate the average project profit for the entire period, and then simply divide it by the capital invested. So there is no complex calculation involved in it. That's the reason it is simple to calculate. But couple of things which act negative with respect to ARR is it does not talk anything about the timing of the cash flows. No cash, we are only talking about accounting profit. And we have looked at in our P&L statements and other in the balance sheets, etc., in the financial accounting part, P&L is more of an accrual related tool. So it has nothing to do with the timing of the cash. I don't know, I may be receiving the cash earlier or even later. So because it does not take into account the timing of the cash flows, it's more of assumption based. It's more of it's not more on a realistic standpoint, because most of the financial analysts look at the analysis of the company from a cash flow dimension, which is a reality dimension, rather than a profitability kind of a dimension. So from that perspective, it lacks the importance. Whereas the other 3 methods which I am going to deal with, the NPV, the IRR, and the payback period, all 3 of them are focusing on evaluating a capital project based on their cash flows itself and not on the accounting profit. So that is one aspect that is going against the ARR. And because it is not linked with the cash flows, it has nothing to do directly with the shareholder wealth, because shareholder wealth is more and more associated with the cash flows of the project, because the dividends and all which are given to the shareholder, they are the actual cash flows and not notional movements. So what typically happens is, though in reality I look at the accounting rate of return more similar to return on capital employed, the total capital employed for a particular project, deployed on a particular project, how much return has been generated out of it. So in a sense, it is nothing much different from return on capital employed, but because of it not being able to use the cash flows kind of a concept and not being able to account for the timing of the cash flows, this has become a slightly inferior tool compared to the net present value, which probably we would be seeing slightly sometime down the lane, that it is one of the most powerful tools to evaluate a capital project. So you have to be comfortable with this concept of accounting rate of return, because if you have to evaluate two typical capital projects, you may very well use this as one of the tools to evaluate and take your decision about the investment. All right. So let's move on to our next tool, which is a payback period. And as I said, the payback period, the NPV, the net present value, and IRR, the internal rate of return. These three tools are something which can be taken up or can be effective with the cash flows only, and not with the accounting profit. So let's take one single example and try to understand what each of these three methods are dealing with, and how each of these three methods will help us in taking our investment decisions. All right, so let me just take up an example in a spreadsheet. Let me assume that in year 0, or I have two projects A and B, and in both the projects I'm investing 100 crores, or I may have to invest 100 crores in both the projects in year 0, which is right now. In year 0, I may have to invest 100 crores, and there is an expectation that I will get a cash flow of 10 crores at the end of first year, and 80 crores at the end of second year, and 60 crores at the end of third year in project 1. Whereas in project 2, I am expecting 70 crores at the end of first year, 50 at the end of second, and 30 at the 20 at the end of third year. Okay, some of the key things: in both the projects, I am investing 100 crores. Overall, probably I am getting 150 crores, which means almost 50 crores benefit if I am investing in project 1, A, whereas I am getting overall 140 crores, which is a 40 crore profit if I am investing in project 2 or project B. Now, this is where I need to find out which project is more profitable. Is it A or is it B? Or if I have at the max, I have a capital of, let's say, 120 crores only with me, budget wise. I have set aside 120 crores as a budget this year. So, which means I cannot take up both the projects, because both of them require 100 crores of investment now. Because my maximum budget that is available with me is only 120 crores, the only possibility is I can take only one of these two. If that's the case, which one I should opt for? That is where the three methods, the three dimensions, the payback period method, the NPV method, and IRR method, they are helping us to evaluate the multiple projects using different kinds of formulations. What is this payback period method talking of? It is simply saying how many years or how many months, the length of time, in how many years that whatever the cash you have invested as a part of your initial investment, you are getting it back in terms of cash inflows. In how much time is your entire amount which you have invested coming back to you? So it is measured in terms of time period. How many years or how many months is it taking for your entire initial investment to come back? That is what we are classifying as the payback period. Now, in the first case, you have invested 100 crores, but at the end of 1 year, you have got 10 crores. At the end of 2 years, you got 80 crores, which means by the end of second year, you had overall of 90 crores with you. 10 and 80, 90 crores. You just need 10 more crores in the third year. Whereas in the third year, you have got 60 crores. Assuming that the 60 crores are obtained uniformly in all the months, it's probably like to get 60 crores, if you have taken 1 year, you just need 10 crores to break even, or you just need 10 crores to recover your overall capital that you have invested. So that 10 crores probably would have come back in 2 months. Going with a simple assumption that if 60 crores are taking 12 months, 10 crores will definitely take only 2 months. So which means my total payback period in this case for project A, the total payback period is 2 years, 2 months. 2 years, 2 months. Now the same logic if I apply to B. Okay, I have invested 100 crores. I got already 70 at the end of first year, so I just need 30 in the second. Whereas the second year is yielding 50 crores. So if I say that 50 is obtained in 12 months, 30 can be obtained in 3/5 of 12 months. So probably somewhere around 7 months. So I can say in case of B, the payback period is 1 year and 7 months. Now, the earlier I am able to recover my money back, which is slightly faster in case of B. In case of B, I am able to recover my money back probably 7 months before the case of A. So because the payback period is much smaller in case of B, as an accept reject decision, I would go with the project B itself. If I am using a payback period mechanism to evaluate my capital projects, then I would be going with the B itself compared to A. That is how we use the payback period method to evaluate our capital budgeting projects. Now, so the decision rule here is the projects with a payback period up to a defined maximum period. So probably if I say I should get my money back within 3 years. So any project which is having a payback period below 3 years should definitely be accepted. But because there is an initial cash outflow that is coming up, there is a kind of a rationing kind of thing that will occur on our cash flow. We don't have unlimited access to capital, right? Hardly, as I talked about in the earlier example, though both of them have a payback period less than 3 years, because I have a total access to capital of only 120 crores and each project requires 100 crores of investment, I may simply think of going ahead only with one of the two projects. And if I'm using payback period as a mechanism to evaluate the projects, that particular project with a lesser payback period would be chosen out of the two. But again, the biggest drawback with this approach is, let's say I'm talking about a fourth year. I'm assuming that in the project A, I get 200 crores and in the project B, I don't get anything. Still, the payback period method says you accept the project B only. The reason being, once the payback period is crossed, the remaining cash flows, whatever are coming up, the payback period does not bother about them. Here you are getting 200 crores in the fourth year, but whereas 0 crores in the fourth year for this project, but still it says you go with the project B only. So it does not take your total cash flows into consideration or any cash flows that you are getting beyond the payback period date. That is something which will make your entire analysis weaker. So that's the reason after the payback date, it does not consider the relevant the cash flows at all. This is what will make the payback period much a weaker tool compared to the next one, which we are going to discuss, the net present value kind of a method. And it is also not taking into account the timing of the cash flows, though it is taking cash flows into consideration. It is not taking into account the timing of the cash flows. What are we talking about? Timing of cash flows? It is saying a 10 crores you receive today or 10 crores you receive after 2 years. Both of them are one and the same. But in reality, that's not the case, right? If I get 10 crores today, probably I would have invested them even at 5% interest. And after 2 years, it would have become probably 11 or 11 and a half crores. Whereas the 10 crores which I get after 1 year, after 2 years, it is just 10 crores. So that is what we mean by the timing of the cash flows. So though the amount is the same, the earlier I get, the higher the value that is associated with it. That is the meaning of time value of money. Though it's the same amount we are talking of, the earlier I receive, the better it is compared to later. The reason being the interest. Probably if I get that money earlier, I would have invested it somewhere else and would have gained some kind of interest on it compared to getting the same amount after some period of time in future. So the payback period does not talk anything about the timing of the cash flows. And from that standpoint, there is a lot of impracticality to use, especially for highly developed kind of companies. And what is also observed is very small companies, and probably where the management is not very highly qualified, those companies tend to use a payback period method, whereas highly sophisticated companies, large public oriented companies, where the management's education level and all are quite high, they tend to use more of an NPV kind of a method compared to the payback period method. So that's where we are saying this method is much inferior to the NPV method, but it is very easy to calculate and probably provides a very good ballpark figures regarding the acceptance of a particular project. All right. So now let's move on to the third thing called net present value method. But before that, just now as I hinted on, when we talk about time value of money, it is simply saying the $1 today or 10 crores today is much worthier than 10 crores after 1 year. The reason being, if I am receiving 10 crores today, there is some interest which can come on this. But if I am getting 10 crores after 1 year, there is an interest loss on it. So because of that, the earlier the better it is. And there is a risk associated. If I am receiving 10 crores today, I am guaranteed about the receipt of 10 crores. But if I have to receive it after 2 years, I'm not sure whether I will be able to receive it or not. So there is an extra risk that we are taking. And as we have been discussing, higher the risk, higher should be the expected return, which means I should be compensated with more. And there is an effect of inflation also. If I'm talking about the same 10 crores which I receive after 2 years, their value may be much down. Because of inflation, my purchasing capacity may actually go down. The same 10 crores, probably during our parents' time, a salary of 10,000 used to look very luxurious 30 years back. But currently, if I talk about 10,000 rupees per month as a salary, it is not meeting anything. Though the same 10,000 is there, but because of passage of time with respect to inflation and various aspects, the purchasing power has gone down with the passage of time. So the same money is not the same across the different points in time. This is one key aspect of time value of money. And your both the next tools, the NPV and IRR, which are used for capital budgeting projects, they take the help of this particular concept in making the decisions about the capital projects. Now, the NPV mechanism, very simple. The same logic, okay, I'll not take the fourth year now. The same logic, the NPV simply says whatever the cash you are getting in the future years, whatever the cash you are getting in the future years, you try to find out the equivalent present value of that. As I said, the 10 crores which I get after 1 year may not be the same as the 10 crores which we are getting today. Then how much is it equal to? Right? The 10 crores which I get after 1 year, we are saying that it is not the same as 10 crores today. So my next question comes out like how much is it equal to as of today? And that is what is nothing but for what value of money I have today with some expected rate of interest, it will become 10 crores after 1 year. How much money should be there today, which I deposit at X% rate of interest, would fetch me an amount equal to 10 crores. The same way, let's say if I have to interpret about this 60, how much money should be there today, which if deposited for a 3-year period at some X% interest, would fetch me something equal to 60. So what we are trying to do is all the future cash flows, I am trying to find out their expected present values. What is the present value corresponding to this? What is the present value corresponding to this? What is the present value corresponding to this? And add up all these present values and subtract 100 from it, which will give me the net present value that is associated, which means as of today, I have to invest 100 crores. And as of today, I would be getting the present values of each of these three. So the net, if it is positive, then it means if I express everything in today's terms, I'm receiving more compared to what I am paying, which means this project is profitable project for me. So for example, how do I do it? Let me assume that as an investor in this project, I require a 12% return. Right? If I require a 12% annual return on this particular project, my NPV, when I use a tool like NPV spreadsheet, there is a formula called NPV in the spreadsheet, which takes only 2-3 things. It asks for what is the annual return that you are expecting on this project, and what are all the future benefits you are going to get out of this project. So you specify the future projects that you are going to get out of this project and the annual interest rate associated with these projects. And to this, you subtract the initial investment that has been made into it. So finally, it says that the NPV of this project, I will do a format cells into only 2 decimals. So it gives me that the NPV associated with the project is 15.41 crores, which means if I invest 100 crores today, whatever is this 150 crores, the present value of them is equal to 115.41 crores. So if I remove that 100 crores from it, it is saying that as on date, I have a profitability of 15.41 crores. So though I'm getting in net 50 crores as a profit over the next 3 years, The present value of all those benefits is just equivalent to 15.41 crores. But yes, first of all, this number is positive, which means my benefit, the present value of the benefits are more than the present value of the costs, which means it is better for me to take up the project. But again, if there are multiple projects that are available to me, whereas as a capital requirement or as capital restraint constraint, I have to take up only one project, then the simple logic for me is, out of the multiple projects that are available, choose that particular project which is having the highest possible NPV. So this particular project is having an NPV of 15.41 crores. So I'll try to find out the NPV of the second project also, and based on that I will take up my investment decision. Now what is the NPV of the second project? Equal to NPV, the interest rate is 12%, the future cash flows are this, and to this I'm going to add up my initial investment. Finally, this is saying the NPV of the second project is around 16.59 crores. Now you see the difference, 16.6 crores. Though overall you are getting 140 crores only as a part of the second project, whereas you are getting 150 crores as a part of the first project. When you take the time value of money into consideration, you are finding that the first project is having a profit of only 15.4 crores, whereas the second one is having 16.6 crores. So from a time value of money standpoint, it's better to accept the second project compared to the first one. It's better to accept the second project compared to the first one, because the NPV is higher for that particular project. So as a decision rule, a particular project which is having a higher NPV compared to the other is what would be the accepted kind of a project. Now let's see all the important aspects going into it. So just to summarize what we have looked at in the spreadsheet, NPV is nothing but sum of the discounted values of the net cash flows. So all the NPVs we are talking about, if the total net of all the present values is positive, I would be taking an accept decision on the project. Otherwise, I would be rejecting the project. So some of the key things is, it is one particular tool which is linked directly with the shareholders' wealth. The simple reason being, if the NPV is positive, it means it is adding some additional value to the company, because a project is having a higher a positive NPV means overall the value of the company is growing up by that extent. So if the NPV of a project is 16 crores, I can very well assume that the value of the company is growing up by 16 crores. If the value of the company goes up by 16 crores, probably the value per share also goes up by some number, because company value of the company divided by the total number of shares is what is the value per share going up. So which means it is directly related to the shareholders' wealth itself. And unlike the other two tools which don't consider the timing of the cash flows, this is heavily dependent on the timing of the cash flows, because here also we have seen that though the project A is totally giving me 150 crores, whereas the project B is only 140 crores, but still the decision was to go ahead with the project B itself, because it was focusing more on the timing of the cash flows. The time value of money became a very important factor, and that is where there is a lot of practicality of use for this particular concept. Then similarly, there is one more concept that is very heavily in use called the internal rate of return. Again, This is a tool which simply says at what particular rate of return the NPV of this particular flow is becoming zero. So, which means there is some linkage with the NPV itself. Here I have taken 12% as a particular interest rate because an investor is expecting 12% return from this particular investment. But now what the IRR method is saying is what number you have to take for that return so that the NPV value is zero, which is the scenario of no profit, no loss. Or another scenario of what is the return which the project is giving. Instead of how much return would an investor expect, we are simply saying what is the return which this project will offer. What is the annual return that is typically offered by the project? That is what we are calling as the IRR. So simply put, if I'm looking at the IRR, again in a tool like Excel, there is a formula called IRR. So if I simply take the IRR of these four values, which should include my initial investment also, it has come out that the IRR of this project is 19%. So the investor's expectation is 12%, whereas this project is generating 19%. So as long as the project is generating a better return compared to the investor's expectation, we should go ahead accepting the particular project. Otherwise we may have to reject it. But again, the same scenario, if at all I have a capital constraint in place, I cannot accept all the profitable projects. So if I am using IRR as a mechanism to evaluate the capital projects, then I have to choose that particular project which is having the highest IRR itself. So for the second project, I am taking IRR, and that is giving me something like around 24%. So even in the IRR standpoint also, we are seeing that the project B is having a higher IRR compared to the project A. So even if I am using IRR as a decision making tool, it is being supporting the project B itself. Whereas in some cases, what could happen is NPV and IRR, both of them may give conflicting decisions, especially when I have to choose only one project, not all profitable projects. Especially if I have to choose between only one project out of the various available ones, the rankings could be different between the NPV and the IRR mechanism. So in this case, the experts have suggested wherever there is a clash in the rankings given by these two mechanisms, it's better to go with the one that is chosen by NPV itself, because on an overall scale, NPV is adding up to the shareholders' wealth, whereas the others are not directly adding up to the shareholders' wealth. And a couple of disadvantages that are there with the IRR is there is a possibility that a particular project can have multiple IRRs or even zero IRR, no IRR. So no IRR means comparisons will become difficult, and if there are multiple IRRs means I don't know which IRR to use. So because of that particular problem, NPV is a far better tool compared to the IRR. But otherwise, if I have to compare IRR with respect to, let's say, payback period or any other method, I would definitely rate IRR as a much better tool compared to the other two, because on the positive side, it takes all the cash flows just like your NPV method. It also looks at the timing of the cash flows. It gives a lot of importance to time value of money. So these are all acting as positive. But as I said, in some projects, especially what we call them as is unconventional projects, What are these unconventional? See, in a conventional project, it is like this. Today I invest, and in the future only I will get the return. So there is only one time investment, and in the future it is just the benefits out of it. But when I say unconventional projects, it may so happen that the investment is being made at multiple points in time. So cash inflows and cash outflows occur at different points in time. There are multiple places of cash outflows. These are the scenarios of unconventional projects. And what is observed is, with respect to unconventional projects, we find that there is a possibility of multiple IRRs or even no IRRs. So from that standpoint, the IRR becomes a slightly weaker tool compared to NPV for your capital budgeting decision. So if you are comfortable with these four aspects of evaluating capital projects, and primarily the NPV mode, because when all of them are giving different kinds of conflicting decisions, it is suggested that you depend on the output that is given by the NPV model itself to take your decision regarding the capital project investments. So just to link between NPV and IRR, that if I plot NPV here for different rates of return or the expected returns of the investors, that particular rate of return. So if we are seeing, if the investors expectation is 12%, the NPV is heavily positive. Probably at 20%, this is the NPV, still positive. But at 30%, the NPV is negative, which means you should not accept. If the investor's expectation is around 30%, then he should not accept this particular project. And what is the IRR saying? Probably at this 27-28%. If the investor's expectation is around 28%, then the NPV is equal to 0. So if the investor's expectation is less than this 28%, accept the project. If the investor's expectation is less than 28%, accept the project, because there the NPV is going to be positive. And if the investor's expectation is more than 28%, reject the project, for the simple reason your NPV is going negative at that particular point. So that's how you can link between the NPV and IRR of a project. So some of the important things, especially when you are looking at all your cash flows and all, the first thing is, which we have already looked at just now, I should not consider the profits. Only the ARR is a mechanism that considers it. But most of the times we focus only on cash flows, and that too after tax, because the tax amount is something that goes to the government. So which is not a value addition or a benefit to the investor. So that's the reason the investor has to focus primarily on the after tax cash flows itself, not the pre-tax. And while computing your cash flows, please do not consider any sunk costs or the past incurred costs. The reason being, your decision is primarily based on your decision which you are taking now. The decision which you will be taking now is based on the future benefits and future costs that you are going to incur. Nothing to do with the past. So any kind of past investments, don't take them as an input in any of your models. Even if you are using an NPV, IRR, whatever the mechanism you are using, never consider the past costs or the sunk costs as a part of the decision making process. Only the current investment that is required and the future benefits that are expected in the form of cash flows, only those need to be considered. And even in the future, if all the projects have very common future costs, let's say the employee's salary is going to be the same for all the projects. So if at all I am seeing that The future costs are common for all the projects. You don't need to consider them because they are not going to be the differentiators in your decision making process. So you can omit them. Whereas it's always a mandatory thing to consider the opportunity costs as a part of the cash flows, because any cash flow which is getting generated, if you have accepted one project, probably you would have rejected a couple of other assignments. So what is the negative impact by rejecting that particular projects? So only that incremental benefit needs to be considered, because you have lost the opportunity of not doing something else by redirecting your cash here. A simple logic: if you are thinking of investing 100 crores in project A, probably you have lost out on the opportunity of earning a 6% interest by depositing that 100 crores in a bank. That is your opportunity cost. So your cash flows need to take into consideration the opportunity costs also uh, while evaluating the projects for capital budgeting decisions. And similarly, the other factors like cannibalization. Probably you're talking about introducing a new product into the market. Introducing a new product, probably it might be killing your other existing product. So if I try to find out the addition, if I try to find out the future benefits of this particular project, of a new product, I should also take into consideration the loss of sales that is coming up on my existing product because of taking up this new product. This is a scenario of cannibalization. You are eating away your own products, right? It may be very much possible, especially during the acquisitions. If you are taking over the companies within the similar business, then the products may become redundant, and you may want to kill one of the products. In these cases, any kind of value creation or any kind of evaluation of the projects you are trying to do, you need to take into consideration the cannibalization impacts also that come up on your projects, and any kind of financing costs, especially the interest related costs and all. You should take care in the discount rate, which is the expected return of investment, expected rate of return, and you should not include the financing costs as a part of the cash flows. So you have to consider all these important elements while taking your capital budgeting decisions. When we take up one case study on capital budgeting, we can do all these things. We can take care of all these things in our case study of capital budgeting. So looking at in reality which methods are used, as I said, though all these four methods are being used by different companies of different levels, what we see is there is a lot of increased usage of NPV and IRR based models because of because of the time value of money they are considering, and because of the kind of authenticity that is associated with them, with respect to the timing of the cash flows, with respect to considering all the cash flows, and also they are taking cash flows rather than the profits. So what many majority of the companies do is they use more than one method, use one as a verification to the other method. Whereas the simple thing is the larger businesses where the management is more and more sophisticated, and where there are public kind of companies, you are seeing that they are using more and more of the NPV and IRR kind of mechanisms, rather than using this payback period or accounting rate of return kind of mechanisms. All right. So this is what is in a nutshell about the capital budgeting process. I suggest that the next case study which we are going to do on this, where we will take a capital budgeting decision full fledged based on the case study, and that will help us incorporate all these concepts of capital budgeting into it. But I hope the conceptual aspects and the various methods that are involved in the capital budgeting evaluation process are clear to you. If you have any further queries regarding this, I suggest you can feel free to contact me on the number I have given below here, or you can even send me an email at vamsidhar@pacegurus.com. Right? And so the case study which we will be doing on it in the later session would definitely give you even more in depth into the usage of various capital budgeting techniques. Thanks a lot for listening to this session. Thank you very much.